The Bank of Canada left interest rates unchanged after 7 consecutive cuts. Joining me now to discuss the latest decision is Francis Fong, senior economist with TD. And Francis, coming into this meeting, there's a lot of uncertainty about whether or not the Bank of Canada will cut or not. What was it that led them to hold?
Yeah, so this is a real toss-up interest rate decision. Obviously, they held. Our expectation was for a cut, but market pricing was starting to lean more towards a hold. I don't think it changes the overall narrative of where interest rates are headed, but this interest rate decision in particular was sort of at the crossroads of a lot of factors that were difficult for the bank to assess. I mean, you have a ton of uncertainty around trade policy internationally. Donald Trump continues to sort of put out messaging daily around, or confusing messaging daily around where he's trying to move with tariffs, whether he's going to provide relief or whether he's going to slap on new tariffs. And so the bank is really weighing two sort of prevailing factors. One is obviously, what does tariffs do to the inflation outlook? Because it impacts it from a number of ways, businesses passing higher costs on to consumers, but also supply chain disruptions as a result of all this uncertainty. But all of that's happening against the backdrop of a generally weakening outlook. Growth is already weakening, employment growth is weakening. Even the inflation metrics are starting to sort of edge downward, or continuing to edge downwards. The backdrop would notionally provide scope for the bank to have continued to cut, hence our assumption that they would have in this meeting. But it's all dependent on how you decide to look at that tariff impact and what you think that's going to, or what kind of impact that's going to have on the outlook.
Okay, now I'll get to those two scenarios in just a moment, but I want to address the statement today because it really highlighted the uncertainty of U.S. trade policy, and they're pretty clear about that throughout the statement. What does this mean for rates going forward?
Yeah, so I mean, they indicated in the past two meetings now that monetary policy is not there to address trade policy uncertainty, but in a way, they are. Like, there's not really a choice in the matter. At the end of the day, they're deciding the direction of inflation and to a large extent growth, and so they definitely are in that game, whether they like it or not. But certainly, I think if you look at where, and they released the monetary policy report today, if you look at the details of that report in terms of what kind of factors they're looking at, there's really a couple of things that they'll be looking at, which is what kind of impact are tariffs going to have on supply chain disruptions, and where inflation expectations going in particular. That one they honed in on quite a lot. And in particular, they highlighted that inflation expectations are rising to a small degree. There's a lot of uncertainty as to how inflation is going to evolve over the next little while, but I think that's clearly where they're putting their emphasis. So looking at inflation expectations and things like the Business Outlook Survey and their other survey metrics, and then monitoring what other countries are doing. We're receiving notes daily about Hong Kong no longer accepting U.S. Post, China restricting exports of this and that, of critical minerals and other kinds of things, no longer accepting airline and equipment imports. All those kinds of things are going to be really important going forward because it will determine the degree to which supply chains actually get disrupted. And so that'll have implications for inflation here in Canada.
Yeah, we're beginning to see the uncertainty from all the trade policy. I want to get back to the two scenarios, because in the statement, they did give these two scenarios about the duration of tariffs and the economic impact. How do you see things unfolding going forward?
Yeah, so ultimately, this is the hardest element to forecast because we're trying to predict what Donald Trump is going to do, which even for his own administration, I imagine is impossible because a lot of these decisions are being made sort of at the 11th hour, and everyone finds out about it at the same time when he decides to post about it. So this is sort of where there's going to be the most divergence among forecasters about where tariff policy ends up landing. We have our forecast, which essentially has tariffs sort of staying at their current level through mid-year before negotiations start to sort of ease on some of these things. And we're already starting to see trade partners in the U.S. start to line up to try to set up those negotiations. So that's our baseline assumption. But I don't think the Bank of Canada is going to be as definitive, at least in the scenarios they're projecting. They have essentially a few scenarios where they make different assumptions about the degree to which tariffs what level they'll land at and then how long they'll stay. And there's both upside and downside impacts to that in terms of both inflation and growth. And ultimately, it's not even clear at this point which of those scenarios is informing their overall growth outlook. But at this point, clearly they're more worried about those inflation impacts on the upside, hence leaving rates unchanged today.
If we do get a scenario where it's the worst case scenario in terms of the impact to the economy, do you see a possibility of the Bank of Canada doing an emergency rate cut?
Yeah, I think that's really top of mind for a lot of folks, and it's a great question. I think ultimately our view is that we don't have one baked in. Ultimately, our forecast is for 2 more rate cuts through the end of this year. If it were the case that things were to fall off a cliff very, very suddenly, Donald Trump raises tariffs to a very extreme level, that's a possibility. But the degree to which central banks all around the world, including the Bank of Canada, are scrutinizing every single data point, it's very unlikely that the bank would be surprised by a sudden kind of drop in economic activity that would justify an emergency rate cut. Not to say it's not possible, but it would likely have to be quite significant for that to occur. And it's just not in the cards at this point in our view.
Now, all of this is obviously going to have implications for currency markets. Where do you see both the Canadian dollar and U.S. dollar going forward?
Yeah, so there's another kind of volatile factor going forward as well. We've seen the Canadian dollar strengthen recently. That's been based on very broad-based weakness against the U.S. dollar. But our view is that, given that we're starting to see these one-on-one negotiations that the U.S. is conducting with their trade partners, it's going to be much more bespoke at this point in terms of who benefits, who loses, who wins, who loses, all that kind of stuff. So our view is that there's still scope for additional weakness in the Canadian dollar through the middle of the year. But once those tariffs, again, based on our assumption that tariffs do start to alleviate sort of later in the year, then we'll start to see the Canadian dollar strengthen back up. But it's likely not going to be a tremendous amount of movement, a little bit of weakness followed by a little more strength, but hovering around this sort of 70 to 72 cent area that we feel is pretty fair value.
Now, so given all of this, we've got uncertainty of U.S. trade policy, you've got inflation. What are some of the things that you'll be watching closely as the Bank of Canada considers its next move?
Yeah, so I like I said in the outstart, the overall narrative I don't think has changed too much. I mean, if you look at market pricing, the fact that they delayed this cut this time really just pushed market pricing for a cut the next meeting in June, and then we still have one additional cut beyond that, and markets are pricing that in as well. And that essentially just puts you at the bottom range of neutral territory. So not accommodative, but not restrictive, but sort of closer to the accommodative range of the Bank of Canada has neutral between 225 and 325, so just at the bottom end of that range. And that's really, I think, just reflective of we don't really know how all of this is going to play out. So it gives the bank scope to cut if they need to, sort of to your earlier question about an emergency cut. If things start to sort of look really, really bad on the economic front, then it gives them more scope to cut. But on the same token, if they're correct and they're more worried about inflation expectations becoming unanchored, supply chain disruptions start to pass through to prices at a level that's higher than they expect, but also more persistent than they expect, then that also gives them more room to sort of move back up into higher territory.